Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Rocket Lab.
And if you find our talks useful, please consider subscribe, like, and comment underneath.
Right, and a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below.
Definitely.
Grow $100 to $10K with VIP indicators. VIP Indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate.
Which is super helpful for spotting setups.
Exactly. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky.
Always.
Yeah, no indicator can guarantee profits, and growing $100 into $10K is not guaranteed. Use these tools for education and analysis only.
Right. Manage your risks carefully.
Do your own research and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
Okay, so let's jump right in. You know, historically, investing in the aerospace sector felt a bit like throwing your capital into a sleek metallic tube and just watching it detonate on a launch pad.
Yeah, quite literally sometimes.
Right. For decades, it's just been this massive spectacle. You had rich billionaires funding vanity projects, incredible human drama, massive explosions, but very little in the way of predictable, reliable revenue.
No, it was a sector driven by venture capital dreams rather than solid balance sheets.
Exactly. It was a high-risk gamble. But what makes today's deep dive so critical is that we're actually witnessing a fundamental shift in real time.
We really are. We are looking at Rocket Lab, and they are actively trying to turn those explosive high-risk spectacles into, well, boring, predictable infrastructure.
Which is exactly what investors want. Boring is good.
Boring is highly profitable. Their massive Q1 2026 earnings beat really solidifies this. They are graduating from a cash-burning startup into an emerging industrial space powerhouse.
And that evolution from pure speculation to tangible industrial reality is exactly why we need to unpack this stock today.
Absolutely.
All right, let's move into the wealth building context.
So if you are constructing a portfolio for the next 20 years, you have to zoom out. You have to look at Space 2.0 as a multi-decade megatrend.
It's not just about the novelty of launching rockets anymore.
No, not at all. It is about owning the fundamental infrastructure of space. Think of it like the early days of the internet.
Oh, that's a good analogy.
Right. The enduring generational wealth wasn't necessarily made by the people building flashy experimental websites. The real money was made by the companies laying the fiber optic cables across the ocean floors.
Yeah, the foundational layer.
Exactly. Space 2.0 is essentially laying the orbital fiber optic cables. The satellites, the data relays, the defense networks, all of that requires a highway to space, and Rocket Lab is building the toll road.
Okay, let's unpack this carefully, though, because I look at the historical data, and the aerospace sector is notoriously a capital incinerator.
100%.
It's an industry famous for multi-year delays, massive cost overruns, and margins that just, evaporate into thin air the moment a single valve malfunctions.
Yeah, the margins are fragile in legacy aerospace.
So how does a retail investor actually justify putting a space stock into a long-term wealth-building portfolio without getting completely burned?
It's a completely fair question, and it comes down to one word: visibility.
Visibility, okay.
That is where Rocket Lab is aggressively separating itself from legacy peers. We are talking about speculative, maybe someday revenue anymore. They have built a $2.2 billion contracted backlog.
Wait, $2.2 billion? That's huge.
Massive. And contracted is the absolute key word there. These are signed agreements. This transitions the narrative completely away from hoping a startup simply survives the year.
Right. It turns it into analyzing predictable, wealth-building industrial revenue streams.
Exactly. You can actually model out their cash flow for the next several years based on signatures already on paper.
Now let's look at the fundamentals. Because if they are actually building an industrial base, well, the balance sheet has to prove it.
The numbers have to back it up.
Do the Q1 2026 numbers actually back up this whole infrastructure narrative?
They do. The Q1 numbers are what truly validate this inflection point. They hit a record $200.3 million in quarterly revenue.
Wow.
Yeah, that is a massive 63.5% increase year over year.
Which completely crushed the Wall Street consensus estimate, right? I think that was sitting at $192.5 million.
It did. But here's the thing.
But wait, a 63% increase in revenue? Is that actually sustainable growth? Or is that just a backlog of delayed launches all bursting onto the balance sheet at once?
That's the right question to ask.
Because what stands out to me is how the profitability metrics are scaling alongside that top line.
And that's the most compelling part. JAP gross margins hit a record 38.2% and an even stronger 43% on a non-JAP basis.
So they're actually making money on these launches.
Exactly. That tells us they aren't just buying market share by launching rockets at a loss just to look busy. But here's the mechanism you really need to understand regarding their business model.
Let it out.
Space Systems now makes up nearly 70% of their total revenue, and that specific segment is growing at 57% year over year.
While launch services, the actual act of putting things in space, surged 79% year over year, right? On the back of 8 successful Electron and HASTE launches.
Right. And looking ahead, management raised Q2 2026 revenue guidance to a range of $225 million to $240 million.
So the launches are just the delivery mechanism, but the real money is in the cargo and the systems.
Precisely. To understand why these numbers are scaling so fast, you have to walk through their competitive moat. It's a strategy of full-stack vertical integration.
Like Apple.
Exactly like Apple. Think about why Apple is so incredibly profitable. Apple doesn't just sell you the glass and metal of an iPhone.
Right. They own the iOS operating system. They take a 30% cut of the App Store, and they sell you the services.
They capture margin at every single layer of the ecosystem. Rocket Lab is doing the exact same thing for orbit. They don't just build the rocket, they build the satellite bus it carries, and they build the mission software that runs it.
And they are aggressively acquiring companies to close any gaps in that ecosystem. I mean, they bought Mynaric for optical communications, and they have the pending acquisition of Motive Space Systems.
Which is a huge strategic move.
Yeah, the sources mention that buying Motive allows them to insource highly constrained components like solar array drive assemblies. Let's actually explain why that matters to an investor.
Please do, because it sounds super technical.
It does, but look, if you're building a satellite, you need it to catch sunlight to stay alive. The drive assembly is the robotic motor that keeps the solar panels pointed at the sun while the satellite whoops around the Earth at 17,000 miles per hour.
Right, it's mission-critical hardware.
Exactly. And right now, there is a massive industry-wide waitlist to buy those specific parts from niche suppliers. By bringing that in-house, Rocket Lab doesn't just save a few dollars.
They control their own manufacturing destiny.
Yeah, they completely bypass an industry-wide bottleneck. They effectively lock out smaller competitors who still have to wait in line.
That's exactly how vertical integration becomes a weapon. It de-risks their entire supply chain.
I hear the bullish thesis on the ecosystem, and it sounds brilliant in theory, but we have to look at the bottom line objectively.
Let's do it.
They still posted a GAAP net loss of 9 cents per share in Q1. The research and development spending, particularly for their new, larger Neutron rocket, is absolutely massive.
Oh yeah, Neutron is not cheap.
No, it's not. They are still in a highly capital-intensive phase, burning through cash to build out this future.
I'm not going to sugarcoat the R&D burn. It's heavy. But you have to look at how they fortified the balance sheet to handle that burn.
Right, the recent capital raise.
Exactly. Following a recent at-the-market equity offering, they exited the quarter with access to over $2 billion in total liquidity.
Which effectively de-risks their near-term cash flow profile. I mean, having a $2 billion war chest means management doesn't have to worry about keeping the lights on next month.
They can just focus on execution.
Yeah, they can focus on winning massive prime contracts. And we are seeing the results of that, like the $816 million Space Development Agency Tranche 3 award.
That contract is a game changer.
It is. Let's talk about how the Department of Defense views this. The Pentagon absolutely hates having a single point of failure.
Oh, they despise it.
Right now, SpaceX dominates. The DoD desperately needs a viable, fully funded second option to ensure national security access to space.
Yeah, they can't rely solely on one provider.
Exactly. So when Rocket Lab sits down at the table with $2 billion in liquidity, the DoD views them as a reliable, established prime contractor, not some fragile startup that might go bankrupt halfway through the contract.
That is the crucial pivot. It makes them the only credible, pure-play alternative to SpaceX in the eyes of the U.S. government.
That brings us to the catalyst timeline.
If we look at the next 3 months, there are several major operational and financial events to watch. First, Q2 2026 earnings are expected in early August.
So, just around the corner.
Yep. The market will be laser-focused on that $232.5 million revenue guidance midpoint. Wall Street wants to see if they can maintain that gross margin expansion while scaling up operations.
But the real operational catalysts are the neutron rocket milestones over the next 90 days.
Absolutely. The hardware progress.
We need to see concrete updates on the Archimedes engine qualification, advancements on the carbon composite second stage, and progress on the reusable fairings ahead of the targeted Q4 2026 debut.
Yeah, that Q4 timeline is critical.
Why does Neutron matter so much? Because the Electron rocket is great for small payloads, but the medium lift market, which Neutron is built for, is where the real heavy-duty industrial cash flow is.
It's the workhorse category for deploying mega constellations.
And alongside the hardware development, the contract momentum has been staggering. They just signed the largest launch contract in company history, covering 5 Neutron and 3 Electron missions.
Add to that a $30 million HASTE contract with defense contractor Anduril and being selected for the Golden Dome space-based interceptor program.
The defense tailwinds are just massive right now.
We really are.
And there's a broader macro trend at play here that we cannot ignore. We are witnessing a clear sector rotation out of legacy aerospace and into Space 2.0.
A huge shift in capital allocation.
Yeah. With persistent inflation and high treasury yields over the last year, the market is punishing capital-intensive, margin-compressed legacy players like Boeing and Lockheed.
Investors are losing patience with the old guard.
They are. Investors are actively dumping those older, slower-moving names and rotating capital into younger companies that actually have tangible, contracted backlogs and cleaner balance sheets.
Which perfectly positions Rocket Lab to capture those institutional inflows. They're absorbing the capital, fleeing the legacy aerospace sector.
Now let's pivot to the chart.
The technical price action reflects this fundamental breakout perfectly. Following the Q1 earnings release on May 8, 2026, the stock surged 34% in a single trading session.
34% in one day.
Yeah, it was the best day in the company's history, pushing the price to an all-time high of $133.18.
The structural setup is incredibly aggressive right now. The price is trading in a classic stacked moving average formation.
Yeah, it's really gapped up.
For context, it sits roughly 44.2% above the 20-day simple moving average, which is around $82.08, and an astounding 87.8% above the 200-day simple moving average at $63.01.
That's a massive premium over the long-term trend.
Let's translate that for the listener. When a stock is nearly 90% above its 200-day trend line, that isn't just retail day traders hyping up a stock on a message board.
No, that takes serious money.
That is sustained, heavy institutional conviction. That stacked moving average means the whales are moving in.
That kind of alignment confirms an established, dominant uptrend. From a structural standpoint, the prior 52-week high of $105.62 has now flipped.
Meaning it went from resistance to support?
Exactly. It used to be a ceiling that the stock couldn't break through, and now it acts as a breakout retest support level, a new floor. Meanwhile, we're seeing fresh resistance forming near the $118 round number area.
Okay, so the bulls are definitely in control.
The momentum is clearly showing that upside pressure is overwhelming downside pressure, with the MCD indicator pushing positive. We're also seeing heavy institutional volume, with multiple whale alerts triggered over the past week.
Suggesting massive block trades and institutional accumulation behind the scenes.
Exactly.
Okay, but this is exactly where we need to exercise caution, look at the listener, and throw a little cold water on the excitement. If you're listening to this and you've got serious FOMO because the stock just popped 34%, you need to take a breath and look at the whole picture. The momentum is strong, but the relative strength index, the RSI, pushed into the mid-70s following that parabolic rally.
Yeah, that's getting pretty frothy.
An RSI in the mid-70s means this stock is boiling hot right now. A 40% plus surge across just 2 trading sessions creates severe short-term extension risks.
You don't want to chase that straight up.
No. When a stock gets this extended above its moving averages, it enters highly overbought territory. If you buy in today at the absolute top, you are stepping directly into a potential pullback or a prolonged, choppy consolidation period.
That's a vital warning. Markets don't go up in straight lines forever, even with great fundamentals.
So what does market sentiment look like?
Despite those technical extension risks you just outlined, the broader market mood is distinctly, undeniably bullish.
It really is.
The market is aggressively rewarding this transition from a venture capital R&D burn into a maturing industrial leader. And you can see that reflected in the analyst actions.
We've seen a ton of upgrades recently.
A flurry of aggressive price target upgrades for 2025 and 2026. Needham raised their target to $120. Cantor Fitzgerald bumped theirs up to 96. Deutsche Bank raised their target by 64% to 120. And Clear Street just initiated coverage with a street-high target of $150.
There is also a speculative catalyst floating around the market that we should definitely address. There is intense chatter right now about a potential SpaceX IPO.
Yeah, the mega IPO rumor.
On the surface, that sounds terrifying for a smaller competitor.
Right. Initially, conventional wisdom might suggest a massive competitor going public would suck all the oxygen and the capital out of the room.
But Rocket Lab's CFO actually views it differently, and the market mechanics back him up. He noted that a SpaceX IPO could be a defining moment that forces weak, single-point competitors into obscurity while massively benefiting established, vertically integrated players like Rocket Lab.
Let's explain the mechanism behind that because it's fascinating.
Yeah, please do.
If SpaceX goes public, it triggers massive, sector-wide ETF inflows. Think about the aerospace and defense ETFs or innovation funds.
Right.
If the undisputed leader of the space economy hits the public market, every major fund has to rebalance their portfolios to include space infrastructure.
Because they can't afford to ignore the sector leader.
Exactly. But they can't just put 100% of their space allocation into SpaceX. Portfolio risk rules require them to diversify across the sector.
Ah, I see.
So by default, a tidal wave of institutional cash is forced to buy into established secondary proxies to balance the trade. A rising tide lifts all fully funded boats.
Exactly. It validates the entire sector and forces Wall Street to allocate dedicated space budgets.
Now let's talk about the risks, because the thesis is only as strong as its blind spots.
And we have to look closely at those blind spots. From a risk management perspective, the single most critical vulnerability here is execution risk, specifically regarding that new Neutron rocket.
Yeah, that's the elephant in the room.
The market is actively pricing in a Q4 2026 debut for Neutron. If that schedule slips materially into 2027, which happens all the time in aerospace, the consequences compound quickly.
First, it extends their heavy cash burn.
Second, it damages management's credibility with the DoD and those commercial clients who already signed contracts.
Right, nobody likes delays.
And crucially, it leaves a wide open window for competitors to steal market share in that highly lucrative medium lift category while Rocket Lab is still doing engine tests.
Developing a medium lift reusable launch vehicle from scratch is incredibly complex engineering. But the mitigation here is that the demand is already proven.
The market clearly wants it.
Yeah. As we mentioned, they already have 5 Neutron launches contracted before the rocket has even flown. Customers believe in the engineering team. Management has also shown a proven ability to navigate hurdles, keeping the current timeline mostly intact despite some early expected tank test failures.
But even if execution is completely flawless, I have to push back on the math here. We have to talk about valuation risk.
Yeah, the valuation is steep.
Following this recent 34% surge, the stock is trading at over 108 times sales.
I know, it's a staggering premium.
It's massive. Let's put that in context for the listener. Its 5-year average valuation is 14.6 times sales. If you buy a company at 108 times its annual sales, you aren't paying for what they are doing today. You are paying for a flawless, completely uninterrupted execution of what they promised to do in 2028.
You're paying for future perfection.
At 108 times sales, this stock is priced for absolute perfection. There is zero margin of safety built into that multiple. If macroeconomic conditions tighten, or if a single Archimedes engine test fails on the pad next month, a stock priced at that level is highly vulnerable to a violent, rapid correction.
You're right to highlight that vulnerability. It is priced for perfection, but you could argue, and the institutional buyers clearly are arguing, that the premium is justified by the unprecedented revenue visibility.
The backlog, right.
Exactly. Having a $2.2 billion contracted backlog, combined with $2 billion in immediate liquidity, removes the near-term dilution risk that usually plagues high-growth industrials.
They don't need to issue new shares to survive.
Precisely. They are fully funded right now to execute on that massive backlog.
So with everything on the table, what's the final verdict?
Based on the underlying research and the data we've unpacked, the Buller score sits at a very strong 8 out of 10.
Okay, an 8 out of 10.
The core investment thesis here points to a multi-year hold. Rocket Lab has definitively evolved from a speculative small launch provider into a vertically integrated space prime contractor.
The infrastructure angle we talked about.
Right. The upcoming Q4 2026 debut of the Neutron rocket is the fundamental key to unlocking high-margin, medium-lift economics that will finally allow them to challenge SpaceX directly for the biggest payloads.
But the absolute key phrase for the listener there is multi-year hold. If you are looking at this space, you need the patience to look past short-term, overbought technical fluctuations like that boiling hot RSI we talked about.
Yeah, you have to ignore the short-term noise.
And wait for that $2.2 billion backlog to actually convert into realized revenue and free cash flow on the balance sheet. It circles right back to where we started today. You aren't investing in the spectacle of an exploding rocket anymore.
No, you are investing in the long, slow, highly profitable process of laying the infrastructure for the next industrial revolution.
It's entirely about patience and executing on the backlog.
Exactly.
And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is grow $100 to $10K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate.
But again, trading always carries risk.
Right, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.